This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, March 10th, 2016, featuring Update Analytics, incorporating data from the Update Energy Feed, Baker Hughes, and CME Group NYMEX. We'll break the report down according to the 5 regions tracked by EIA, beginning with Pacific, then Mountain, Midwest, East, South Central, and then the overall lower 48 United States. Highlights from this week's report: we experienced a 57 BCF drawdown. All regions had an increase in their surplus. 3 of the 5 regions have begun injecting gas, and we'll review where we're at as drawdown season nears its end. Let's go to the charts. All the charts are constructed the same. In the top pane, the heavy blue line is the gas and storage. The black dash line is the 5-year average of storage. The light green dash line is the 5-year average maximum, and the light red dash line is the 5-year average minimum. In the center pane is either an injection or withdrawal for that week, green being an injection, red being a drawdown, and in the bottom pane is the delta between the gas in storage and the 5-year average, indicating whether we have a surplus or a deficit in storage. Beginning with Pacific region, there's 258 BCF of gas in storage, right up against the 5-year average maximum, the light green dash line. This is one of the regions we talked about that had a 3 BCF injection, and the surplus this week is increased to 56 BCF. In addition to the gas and storage, we look at the delivery points in the various regions. Out in the Pacific region, we have 2 PG&E and SoCal basis. This is the basis differential between Platts and the Henry Hub, and indicates whether gas is trading at a premium or a deficit for that given region. You can see at this region, PG&E has a slight surplus, and we're trading at a deficit on SoCal. Over to the Mountain region. This is another region that experienced a 1 BCF injection there in the center pane for 146 BCF of storage, well above the 5-year average maximum, and a 26 BCF surplus in the Mountain region. Not surprising, both delivery points that we cover, Rockies and San Juan Basin, are both trading at deep discounts with that excess supply. In the Midwest, we had a 34 BCF drawdown, 587 BCF of gas and storage, just slightly above the 5-year average maximum, and 187 BCF surplus, which ties last week's record surplus. Only one delivery point we cover, and that's MidCon, and it's relatively stable, trading at a slight premium. In the eastern region, we had a 31 BCF drawdown, 464 BCF in storage, roughly between the 5-year average maximum and the 5-year average. The 101 BCF surplus ties last week's record as well. 3 delivery points that we look at in the east, all of them are trading at discounts. One we talked about last week, we'll take a look at it again. This is Transco Zone 6. This is up in the Pennsylvania area, and you can see we started the year here at $2.25 premium, and that is now depleted all the way down to a 40-cent discount in less than 90 days. That definitely demonstrates some of the gas overhang in that region. South Central region, this includes Texas and Oklahoma. This is primarily what would we used to consider the producing region. Still over 1 trillion cubic feet of gas in storage there, with a 4 billion cubic foot addition, well above the 5-year average maximum, and the 357 BCF is an all-time record surplus for that region. Consistent with that storage overhang, you can see that in the 4 delivery points in the South Central region, all of them trading at deep discounts. For the overall lower 48 United States, in the center pane, we can see the 57 BCF drawdown we talked about at the beginning of the report. Moving to the upper pane, 2.5 trillion cubic feet of gas in storage, above the 5-year average maximum, and obviously well above the 5-year average. Last week we covered that brown dashed line that goes across there. What that is that goes back to 2012. 2012 had the highest start to injection season of the past 10 years. We're watching very closely, as we should only have another week or two where we'll be drawing gas down, and we want to see where we begin the injection season if it's above that. Right now, it seems highly likely that we will start above with a new all-time record of gas and storage for the start of injection season. Exploration and production activity, we measure this with the Baker Hughes North American rig count. This is all rigs. All land rigs in North America. So this includes rigs exploring for oil as well as natural gas. You can see the sharp drop off over here on the right side all the way down to the current level of 463 rotary rigs active in North America after stacking out 10 last week. I just had to make an adjustment there to the brown dashed line. If we follow that all the way back to the left, we have to go back to the summer of 1999 to find a similar level of exploration and production activity. So we are near a record low in exploration and production activity for all of North America. Going over to natural gas, this is something I want to highlight here. This is rotary rigs in the United States only, focused on exploration and production for natural gas. The 242 level indicated by the red dash line goes all the way back to 1992. That's the all-time record low previous to 2015 for natural gas activity. Last week we stacked out 5 rigs and that took us down to 97. I'm not one to focus on anything like emotional or significant levels, but I think it is important to consider that this is the first. In addition to this being a new all-time low, now being less than 100 rigs in America exploring for natural gas, I think that gets people's attention and probably indicates that there's some expectation of supply constraints, and we'll take a look at how that's reflected in pricing. Beginning with pricing, the first thing we always look at is the seasonality. In the top pane we have NYMEX Henry Hub natural gas futures. This is the data from eSignal, so this is not roll adjusted. In the bottom pane we've used Updata Analytics to calculate the 10-year weighted average of annual seasonality, and that is weighted to the most recent years. What I've done on this chart is use the drawing tools to highlight a couple of key times during the year. The green shaded area indicates a typical time of seasonal strength, and if we go back to 2015, you can see that began in the middle of March and extended all the way to the latter part of June. Almost immediately that this turns into seasonal weakness for the remainder of the summer. That's the area highlighted in pink, and you can see at the end of June there we had seasonal weakness. During that time last year, during the seasonal strength, gas was volatile, but then we did trail off a little bit during the seasonal weakness. Moving forward now to 2016, we anticipate, based on these calculations, the end of March, early part of April, that we'll begin to enter the time of seasonal strength. We're not there yet, but just need to be aware that that is coming up. The daily cloud chart, this is the same data stream, so this is still NYMEX Henry Hub natural gas futures, the continuous contract from eSignal, not roll adjusted. The great thing about these cloud charts is at a glance we can tell where we're at. Important things we look at: the price, that's the red and white candlestick chart, is well below the cloud spans. The cloud spans are negative. You can see that by the shaded pink area there to the right. The green turning line is below the standard line. And really the only thing positive on this chart is that the price has now moved above the turning line after getting down and touching nearly $1.60 an MCF or MMBTU. So this is still a very bearish chart. There is a sharp reversal there at the bottom. But still a long way from being positive. We would need to see it move at a very minimum here above $2.10. That's a long way from $1.75. Shift T and Update Analytics will draw a 3-box reversal if that's what you've set your system up for. In this case, I've got it set up for a 1% box size 3-box reversal. Very similar to what we saw in the cloud chart. The price is well below this bearish resistance line, several intermediate downtrend lines, one active downside target down to $1.56, no active upside target. So whether we look at this from a 1% point and figure chart or the cloud chart, both of these are telling us we still have a negative picture in natural gas in the long term. Moving to the 60-minute chart, this is a 3-box reversal, same data, eSignal's continuous chart. You can see that sharp reversal down here. We have realized a couple of these price targets, so we can change the color on that just to let ourselves know that that was realized. We still have this $1.60 and $1.44 price target, but here's something that we want to be aware of: is we had this sharp reversal down here, and we've begun to see some positive price reaction, and we've got these two upside targets, both at $1.94 or $1.95. Very interesting to see those price targets clustered like that. that in point and figure, that tends to mean that there's a high likelihood we could realize those. However, we don't have a time frame for it, and it seems unlikely that we're going to realize those anytime in the near term, since we're still below bearish resistance on the 60-minute chart. The 15-minute close chart, this is the actual futures, NGJ6. This is April natural gas. You see that reversal off the bottom there, and then that's been somewhat of a volatile climb out of here. When we reported this morning, we were up here around $1.79. We've trailed off just a little bit, but nothing terrible. Over the forward curve, this data via update is energy feed. So this is the NYMEX forward curve of natural gas deliveries going out to 2028. If we go and look back 5 days ago, one thing I wanted to note here, we've had that sharp reversal off the bottom, so it shouldn't surprise us that the curve down here for the rest of 2016 has moved up some. What I think is important to note here, and why I made a point of mentioning the rotary rigs all the way down at 97 and the potential psychology of that given the very depressed exploration and production activity, is you can see this curve has moved up at all delivery points. Not calling a new bull trend, not recommending long positions in natural gas, just being aware that we are down to an extreme low depressed activity level for exploration and production activity, whether we measure this by rigs exploring for oil and gas or strictly U.S. Nat Gas rigs, and that somewhere along the way that constrained supply is going to have an effect. We could be seeing some of the early signs of it here in the forward curve, but this, I'm not calling a trend change yet. We have to stick with the technicals for that. This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, March 10th, 2016. Thank you for joining me, and have a good weekend.